1. Stock. A stock represents ownership in a company. When you buy a stock, you are not just buying a number on a screen, you are buying a small piece of a real business. Imagine a company like a giant building. That building is divided into millions of tiny ownership pieces. Each piece is called a share. When you buy one share, you become a part owner of that company. If the company grows, earns more money, expands to new markets, or creates successful products, the value of your ownership can increase. But if the company struggles, loses customers, or makes poor decisions, the value of your share can decrease. You are connected to the company's success and failure. This matters because owning stocks is one of the most powerful ways ordinary people build wealth over time. Instead of only earning money by working, you start owning assets that can grow. You shift from being just a worker to becoming an owner. And once you understand ownership, the next important question becomes, how much is that ownership worth right now? That's where share price comes in. 2. Share price. Share price is the current market value of one single share of a company's stock. It tells you how much you need to pay to own one small piece of that business. This price changes constantly during market hours. Every second, buyers and sellers are placing orders. If more people want to buy the stock than sell it, the price moves up. If more people want to sell than buy, the price moves down. It's like a live auction happening every moment. News, company earnings, economic conditions, and even investor emotions can influence this price. That's why prices sometimes move quickly, because human expectations are constantly changing. This matters because your profit or loss depends on the movement of this price. If you buy at a lower price and it rises, you gain. If it falls below what you paid, you lose, at least on paper. Understanding share price helps you see how the market values a company at any moment. But what truly drives that movement? The real engine behind price changes is supply and demand. 3. Supply and demand. Supply and demand is the basic force that controls price movement in the stock market. It's the foundation of how markets work. Supply refers to how many shares investors are willing to sell. Demand refers to how many shares investors want to buy. When demand is higher than supply, buyers compete with each other, pushing the price higher. When supply is greater than demand, sellers compete to find buyers, pushing the price lower. It's simple human behavior. Optimism increases demand. Fear increases supply. Every news headline, earnings report, or economic event shifts this balance. This matters because once you understand supply and demand, stock price movements stop feeling random. You begin to see the logic behind volatility. Markets are not controlled by magic. They are driven by collective human decisions. And while emotions move prices short-term, investors also look at numbers to understand a company's true size. That brings us to market capitalization. 4. Market capitalization. Market capitalization, often called market cap, is the total value of a company based on its current share price. It represents what the market believes the entire company is worth. You calculate market cap by multiplying the current share price by the total number of outstanding shares. This number gives you perspective. Market cap gives you the full picture. This matters because company size often relates to risk and stability. Large companies tend to be more established and stable, while smaller companies may grow faster but carry more uncertainty. Investors use market cap to compare companies realistically. And when companies generate consistent profits, sometimes they share that profit with investors. That's where dividends come into play. 5. Dividend. A dividend is a payment a company makes to its shareholders from its profits. It's one way companies reward investors for owning their stock. Not every company pays dividends. Some businesses prefer to reinvest profits back into expansion, research, or new projects. But mature, stable companies often distribute a portion of their earnings to shareholders. If you own shares, you may receive dividend payments regularly, often every quarter. The amount you receive depends on how many shares you own and the company's dividend policy. This matters because dividends create income without needing to sell your shares. It allows investors to earn while still holding ownership. Over time, reinvesting dividends can significantly increase total returns due to compounding. Many long-term investors focus on dividend-paying stocks for steady income and growth. But while dividends offer income, investing always involves uncertainty, and understanding risk is the next important step. 6. Bull market. A bull market is a period when stock prices are generally rising. It reflects confidence, optimism, and strong economic conditions. In a bull market, investors believe companies will grow, profits will increase, and the future looks positive. Because of this confidence, more people are willing to buy stocks, which increases demand and pushes prices higher. You'll often hear people say, "The market is strong," or "everything is going up." That's usually a sign of a bull market. It doesn't mean every single stock rises, but overall, the trend is upward. Businesses expand, hiring increases, and investors feel comfortable taking risks. This matters because bull markets create opportunities for growth. Many investors make significant gains during these periods. But it's also important to stay realistic. Markets don't rise forever. Optimism can sometimes turn into overconfidence. And when confidence starts to fade, the opposite environment can begin, known as a bear market. 7. Bear market. A bear market is a period when stock prices are generally falling, usually by 20% or more from recent highs. It reflects fear, uncertainty, and reduced investor confidence. During a bear market, investors worry about economic problems, company losses, inflation, or global events. Because of this fear, more people want to sell than buy. Supply increases, demand decreases, and prices drop. News headlines often feel negative, and market volatility becomes stronger. It can feel uncomfortable, especially for beginners. But it's important to understand that bear markets are a natural part of the market cycle. This matters because how you react during a bear market can shape your long-term success. Some investors panic and sell at losses. Others see opportunities to buy strong companies at lower prices. Understanding that markets move in cycles helps you stay calm and make rational decisions. And when investing in any market condition, managing risk becomes very important, which brings us to diversification. 8. Diversification. Diversification means spreading your investments across different assets to reduce risk. It's the idea of not putting all your money in one place. Imagine investing all your money into one single company. If that company struggles, your entire investment suffers. But if you invest in multiple companies across different industries, technology, healthcare, energy, finance, the risk is spread out. If one performs poorly, others may perform well. Diversification doesn't eliminate risk, but it helps reduce the impact of any single failure. It creates balance in your portfolio. This matters because protecting your capital is just as important as growing it. Smart investors focus not only on potential returns, but also on risk control. Diversification builds stability and reduces emotional stress during market swings. And when evaluating investments, one important number investors often look at is the P/E ratio. 9. Price-to-earnings ratio. The price-to-earnings ratio, or P/E ratio, measures how much investors are willing to pay for each dollar of a company's earnings. It's a simple way to evaluate valuation. You calculate it by dividing the share price by the company's earnings per share. For example, if a stock costs $100 and earns $5 per share annually, the P/E ratio is 20. This means investors are willing to pay $20 for every $1 of earnings. A higher P/E often suggests high growth expectations. A lower P/E may suggest the company is undervalued or that growth is expected to slow. This matters because valuation helps you avoid overpaying. A great company can still be a poor investment if bought at an extremely high price. The P/E ratio gives context to price. But investors also want to know how much profit belongs to each individual share, which leads us to earnings per share. 10. Earnings per share. Earnings per share, or EPS, shows how much profit a company generates for each outstanding share. It connects company performance directly to shareholders. EPS is calculated by dividing a company's total profit by the number of shares available. If a company earns $1 million and has 1 million shares, the EPS is $1. This number helps investors understand profitability on a per-share basis. When EPS grows consistently over time, it usually signals a healthy and expanding business. Investors often compare EPS across years to evaluate performance trends. This matters because long-term stock price growth is often driven by earnings growth. When profits increase, investor confidence increases, and demand can rise. EPS helps you see whether a company is truly improving or just benefiting from hype. And once you understand profits, the next powerful concept to explore is compounding, how growth builds on itself over time. 11. Compound interest. A compound interest is the process where your money earns returns, and then those returns start earning returns too. It's growth building on top of growth. Imagine you invest $1,000 and earn 10% in 1 year. Now you have $1,100. The next year, you don't earn 10% on the original $1,000. You earn 10% on $1,100. That extra $100 starts working for you as well. Over time, this creates a snowball effect. In the beginning, growth feels slow. But as years pass, the acceleration becomes powerful. The longer your money stays invested, the stronger compounding becomes. This matters because time is more important than timing. Many beginners focus on finding the perfect stock, but long-term investors focus on staying invested. Compound growth rewards patience and consistency. And to stay invested wisely, you need a clear plan, which is where a portfolio comes in. 12. Investment portfolio. An investment portfolio is the collection of all the assets you own, stocks, bonds, funds, or other investments. It's your complete financial picture. Think of your portfolio like a team. Each investment plays a different role. Some are designed for growth. Others provide stability or income. When combined properly, they work together to balance risk and reward. A well-structured portfolio isn't random. It reflects your goals, risk tolerance, and time horizon. Someone investing for retirement in 30 years will build a different portfolio than someone saving for a house in 3 years. This matters because successful investing isn't about one single stock. It's about how everything works together. Your portfolio determines your overall performance, not just one holding. And within many portfolios, investors often include something called an index fund. 13. Index fund. An index fund is a type of investment fund that tracks a specific market index. Instead of trying to beat the market, it aims to match it. For example, some index funds track the S&P 500, which includes 500 large U.S. companies. When you invest in an index fund, you're automatically investing in all the companies inside that index. This creates instant diversification. Because index funds don't require active management, they usually have lower fees. They simply follow the market's performance. This matters because research has shown that many professional investors fail to consistently beat the market over long periods. Index funds offer a simple, low-cost way for beginners to participate in overall market growth. And when investing in funds or stocks, understanding volatility becomes important. 14. Volatility. Volatility measures how much and how quickly a stock's price moves up and down. High volatility means larger swings. Low volatility means steadier movement. Some stocks move 1 to 2% per day. Others can jump or fall 10% or more in hours. These rapid movements are often driven by news, earnings reports, or investor emotions. High volatility can create opportunities for quick gains, but it also increases risk. For beginners, sharp price swings can feel stressful. That's why understanding volatility helps you prepare emotionally and financially. This matters because volatility is normal. Market ups and downs are part of investing. The key is not avoiding volatility completely, but managing it through strategy and diversification. And when evaluating overall performance, investors often look at long-term return. 15. Return on investment. Return on investment, or ROI, measures how much profit or loss you've made compared to the amount you invested. It shows how effectively your money has worked. If you invest $1,000 and it grows to $1,200, your return is 20%. If it falls to $900, your return is negative 10%. ROI helps you compare different investments and evaluate performance clearly. It simplifies results into a percentage, making it easier to understand progress over time. This matters because investing is not just about buying, it's about results. Measuring return helps you adjust strategies, improve decisions, and stay focused on long-term goals. And when you understand ownership, pricing, risk, diversification, compounding, and return, you begin thinking not like a trader, but like a true investor.